My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour, special guest Michael Howell of Cross Border Capital. You have to follow Michael not only because he's a phenomenal thinker and has been spot on with a lot of things here, but because his firm owns Liquidity.com, which I am very, very jealous about in terms of owning that domain. So, Mike, before we get too deep into markets here and the state of the global economy and liquidity, just introduce yourself to the audience as far as your background, who you are, how'd you get involved in markets, and how do you look at things at Cross Border?
Sure, happy to, Michael. Thanks for the invitation. It's a great privilege to be on here on your Spaces slot. I've been in financial markets probably about 30 years now. I started out in the mid-1980s. I worked for an investment bank called Salomon Brothers, who probably many of you with longer memories will recall. Salomon was the preeminent U.S. investment bank, overshadowed Goldman. It was the main investor in or main trader of fixed income markets and forex markets globally. It had a huge footprint, and basically that's why I learned all about liquidity. Liquidity was really the name of the game. If you understood liquidity, where the money was flowing, you had a great insight into financial markets, fixed income markets and forex markets, which is really what it's all about. Equities tag on at the end of that, but if you want to understand the stock markets, you've really got to understand fixed income and forex first of all. And as I say, that comes back to liquidity. About 20 years ago, I set up my own company, Cross Border Capital. We have, as you rightly say, the domain liquidity.com. Liquidity is what it's all about, after all. And basically, we manage a bit of money. We manage about $1 billion, mostly in fixed income strategies. And we also provide research. We do regular research commentaries, narratives about the market. We monitor and track liquidity across what is now 90 countries worldwide, and we publish that data for normal investment firms, for family offices, for quant funds. I mean, you name it. So that's really a quick thumbnail.
All right, so I'm curious, Mike. Has liquidity gotten more complex in the 30 plus years you've been involved in tracking it, and how has that complexity made it more challenging to interpret central bank actions? Because I think you could argue that things were a lot easier to know where funds were flowing when you didn't have as many Fed programs as you do today.
Well, I think it's an interesting point you raised. I think that things have maybe flipped a couple of times in the last 3 decades in many ways. I think one of the observations is that as the world has got bigger in finance terms, it's become a lot more volatile. I mean that's pretty clear. What you've seen in terms of evolution of money flows, I think, goes down 2 channels. I mean, one is the world has geographically got bigger, so you've got to take into account more central banks, try and understand what's going on, not just with the Federal Reserve, but to some extent the European Central Bank, although I think that's becoming a smaller and smaller player these days, but also the People's Bank of China. I mean, that really is key. When I started back in the mid-1980s, it was really about understanding, in particular, the Bank of Japan. I think the Bank of Japan is now, more of a bit part player. And so what you've got are 2 big central banks now, which are kind of ruling the roost, the US Fed and the People's Bank. I think the other thing that you've seen evolve is the complexity of instruments. So you had a period, certainly going back to about 10 years ago, where shadow banking was clearly very important. I think the interesting observation is that in the last decade, largely through the offices of the Federal Reserve and the Treasury, there's been an attempt to try and get control, particularly of dollar credit markets. And what you've seen is tax changes, regulation changes, which have really made the Federal Reserve a lot more powerful than it was at the time of the GFC. So if you kind of want to put a number on that, we would say that the Fed probably carries about 3 times the weight now that it did in 2008. And that's because of a lot of the programs it's instigated, the regulations that are put in place, etc. So watching the Fed and the US Treasury by association are clearly very important once again. They were when I first started, back in the mid-80s. It was the Fed that was the key central bank. I think it lost a lot of its shine in the sort of intervening period up to the GFC. What it's done is regained that very clearly again now.
All right, so I want you, Michael, for the audience here to define what liquidity actually is, because I think a lot of people hear that term and they don't really fully appreciate some of the nuances of how to think about liquidity. So let's go through that for a bit.
Okay, I think what you've got to do first of all is distinguish market liquidity from funding liquidity. Uh, Market liquidity is what you can think of as in terms of the depth of the market in terms of transactions. How easy is it to actually change your asset allocation? In other words, to buy and sell stock. How much can you trade? What sort of price discount or premium is necessary? In other words, the bid-ask spread. That's market liquidity. That's clearly important, but that's derivative, and that comes from funding liquidity. And funding liquidity is really the feedstock into that. And what we're talking about is really the ability to get credit, to either use your existing savings or to actually get credit from a credit provider such as a bank or a shadow bank, or increasingly these days from a central bank. So I think the two concepts are very distinct. Funding liquidity precedes market liquidity. What we think of or people talk about as liquidity is normally the market liquidity, but think back a stage before, and that's the funding dimension.
Okay, that's a very, I think, good distinction. Now, the when we talk about inflation, a lot of people will make the argument that inflation is driven by liquidity and disinflation is driven by a removal of that liquidity. I think the last year or so has kind of shown that that's not entirely a direct cause and effect. I want you to talk about the interaction of that funding liquidity and how much that might explain or maybe not explain not only longer term inflation expectations, but what we've seen the last year or so.
Okay, I think it's a complicated question. I think not a straightforward maybe answer is put it another way. I think if you come back to what liquidity really constitutes, it's really a measure of balance sheet capacity. And what I'm thinking of in these terms is that what we've got out there is a huge mountain of debt. We're talking about 300 trillion of debt. Now, one of the things that a lot of academics and a lot of central bankers tend to forget is that debt has to be refinanced. So, in other words, that you've got a stock of debt, 300 trillion, average maturity 5 years. That tells you that 60 trillion of debt has to be refinanced every year. Now, what you need for that is balance sheet, and that balance sheet measure is liquidity. So, in other words, liquidity you can think of as the capacity or the financing capacity, funding capacity of the financial sector balance sheet. Now, that is something which is kind of different from the concept that many people think of as money supply. Now, the measures of liquidity that we tend to monitor and look at kind of begin where traditional money supply stops. So once you start to look at aggregates like M2, which is a sort of favorite measure of monetarists who think about the role of money in driving economies and inflation, that tends to be money which is much more vested or closely vested in the real economy. The money or the liquidity that I'm talking about is really money that's in the financial sector. It's a sort of different concept, or it's a broader concept. Now, whereas I would say that if the money in the financial sector migrates into the real economy, so it starts to impact M2, then you will likely see some inflationary response to that. And I think that's what we've had in the last 2 years, because a lot of the financial liquidity that's been created has migrated from the financial sector into the real economy, probably actually by dint of the fact that the Treasury has actually used the funding liquidity to make direct payments to individuals within the real economy. You didn't get that after the 2008 crisis. A lot of the liquidity that was then created stuck in the financial sector and didn't migrate out. So I think you've got to draw that distinction. Now, when it comes to understanding inflation, it's a complicated factor. I tend to think that inflation has elements of supply and demand in it. There can be supply shocks. It can be a real economy phenomenon. So it can come through dislocations in the energy markets, as we've seen, and it can equally come from too much money being printed if people have too much spending power. So, it's, as I say, it's not a straightforward answer. Liquidity isn't necessarily the cause, but it may be a factor in that chain.
Okay, so that's interesting. So, and correct me if I'm wrong in the way I heard this, but and I agree with this notion that obviously liquidity after the great financial crisis went primarily to financial markets, and then here comes COVID, and instead of it going to financial markets as most people were used to for the last decade plus, it went more so into the real economy because of transfer payments, so on and so forth. But
Correct.
but that implies that there's a degree of control over where that money is steered to, and I want to hear your thoughts on the ability of policymakers to nudge in some weird way that liquidity to either financial markets or the real economy, and how easy it is then to nudge it the other way.
Well, it's easy in the sense that if they're making direct payments, transfer payments, and that's part of the policy, by definition, it will go into bank accounts, deposit accounts, and it will raise people's spending power. It's direct income transfer. In that respect, they can do that. Equally, you might say that if they tax individuals more heavily, you're taking money out of the real economy. If you engage in government procurement policies or programs, you're equally going to put money into the real economy. So those are direct decisions. If you're a central banker and you're simply expanding the balance sheet of the Federal Reserve, then you've got a hose which is very difficult to direct. You're just spraying liquidity everywhere, and I think that's maybe one of the issues that maybe faces a lot of central banks over the last 2 years, is that they've kind of hosed everything. Everything has got soaked with liquidity. You've seen asset price explosions, and you've got economies in varying states of recovery, depending on how that money drifted into the real economy. So I think that's an inexact science in terms of what central banks do. But I think that the real role of the central bank, as we maybe are seeing, we've seen in the last 2 years, maybe seeing again in the next few years, is much more about financial stability. That's their real goal.
And now part of that stability results in a discussion around refinancing risk, right?
Yeah.
Which I think the way that you frame it is phenomenal. I often say on Twitter that every single major crash, correction, bear market is preceded, doesn't matter what asset class, by one thing and one thing only, and that's excessive leverage, right? And the margin call
Yeah.
is what creates the crash, right? But
Exactly.
it's more than that, in the sense that it's not just leverage, but it's the rolling over of that debt, or at least the ability to refinance and to keep that leverage elevated in the absence of any real bottom line to pay it off. So I want you to talk about, from your work on liquidity and markets, this idea that really what we have to be focused more on is the refinancing part of the equation, and when that refinancing on average tends to take place.
Yeah. Okay. Well, let me step back to the point. So what you've got is you've got something like 60 trillion of debt to roll over every year globally, and that requires balance sheet. Now, balance sheet is liquidity, and central banks, let me say, increasingly control that liquidity. I think that was more of a moot point prior to 2008, where the Federal Reserve, in particular, had lost control of the dollar credit system. And what they've done in the last decade is try to wrestle that control back. Now, the size of the financial sector balance sheet, in other words, let's call that liquidity, is therefore partly determined by the central banks. If the central banks start to withdraw liquidity, in other words, shrink their balance sheets, you will then get a contraction in overall financial sector liquidity, and you will compromise the ability of the system to refinance its debt. And therefore, in other words, you're getting funding crises. Now, I think if you go back and you look over the last decade, and maybe even extend that even before the last decade, every financial crisis has basically been a funding or refinancing crisis. It's been problems in, you can evidence in the repo markets, where the repo markets start to get into trouble. And what the Federal Reserve is forced to go do time and time again is to come back with another QE. Now, at the time of the GFC in 2008, we made the statement, which may have been a bold one then, to say, look, don't think of a QE. QE is like a bottle of pills. There'll be a QE1, a QE2, a QE3. It'll be endless. Every time there's a refinancing crisis, the central bank will have to step back with another QE episode. And I think that's been borne out. So we're engaging in a QT right now, But don't think this is over. It ain't. You're going to see a QE coming forward in a shorter period than many people expect. Now, when will that occur? I would figure it would occur by or before, the early part of 2023. I think the Fed will be back again with more accommodation. I think they simply have to.
So I shared at the top of the space Mike Rowett's tweet here, which I think it kind of encapsulates sort of the challenge that the Fed has and central banks across the globe have when it comes to trying to fight inflation when leverage is so high and when you have these zombie companies that really can barely pay off their interest expense with any marginal increase in the cost of funding. Even before the start of the hiking cycle, the share of the U.S. zombie companies was 3 times higher than during the Great Financial Crisis. Um, I think traditional economics would argue that defaults and bankruptcies are not only a way of cleansing the system, but are a way of breaking inflation. I want you to talk about the state of corporations here in terms of the significant leverage they've taken on because of zero interest rate policy, and how perhaps we may be entering a period where default risk premiums would increase because now the can kicks back, so to speak, in terms of debt and interest rates.
Yeah, I think that's the real problem. I think if you look at the US in particular, the problem is very much in the corporate sector, not so much in the household sector, where it was maybe pre GFC. It's corporations that have taken a lot of that debt. I think you've also got to extend that out to emerging economies. I think a lot of emerging economies have actually sucked up debt with when interest rates have been low, particularly dollar debt, and it is a problem. There's no question about that. Now, the scale of that problem, I think, is at the moment difficult to gauge. But I would say that if you look at the fixed income markets for a steer, the fixed income markets are in many ways the truth. And I think what you've got one of the things that we do in our analysis is that we look at liquidity, but we look for confirming signs in the fixed income markets about what's happening. Now, I think if you start to look at that sequence, you actually get you got a lot of insight. And what I would say by that is to let's look at what's happened to the U.S. term structure, and then look at the implications for of the term structure for the corporate credit markets. By the term structure, I'm talking about what people would think of as the yield curve. So, in other words, it's U.S. interest rates going out to 30 years at different maturities, and what the yield of each of those maturities is. That defines the yield curve. Now, there's been a lot of talk in the media, particularly over the last few months, about the yield curve essentially inverting. And people have said, well, the potential inversion of the curve, many people look at the 10-2 spread as really the convention. That potential inversion is signaling a US recession. Now, I think you've got to step back and say, well, let's actually look at this in a lot more detail or more precision, and try and understand what the term structure is really telling us. And going back to my days at Salomon Brothers, which, as I say, Salomon was the preeminent fixed income house. One of the things to say in that is that it wasn't an inverted curve that was really the thing that worried traders that much. It was much more a flat curve with a big hump in it. So, in other words, you get a hump around the mid-duration maturities of the term structure. Now, that particular configuration was a very negative one for the economy and for the credit markets. And the reason for that basically is if you look at the term structure, you can think of it, or you should think of it, in two very distinct halves. The front end of the curve, say up to about 5-year tenors of about 5 years, is really telling you everything about policy rate expectations, what the Fed is expected to do. Now, what you've seen over the last few months is one of the most rapid increases in that steepness in the front end of the term structure. So, in other words, what you've got is, or you've had, is very low 1-year rates because the Fed policy rate was changing so slowly, but people were expecting a rapid change. So once you got to the 3 or 5-year tenor, you were looking at very elevated rates, well above current Fed funds of testing, in excess of 2%. Now, what that was telling you was that the cost of refinancing for corporations, which tend to refinance around the 3 to 5-year tenor, was becoming hugely more expensive. But that's not the end of the story. The back end of the curve was telling you something even more important. And the back end of the curve was flattening very sharply, particularly from, let's say, 5 to 10 year maturities. So, in other words, the 10-year yield was dropping below the 5-year yield. Now, what that's telling us in slightly wonkish speak is that the term premia in the US Treasury market at the 10-year or longer term tenors was going negative. In other words, you were having to pay the market to own a 10-year bond. So, what the term premium basically tells you is the difference between rolling a bond every year and essentially investing in a longer horizon bond. So, if you get what I'm saying, so the term premium is really a reflection of the of supply and demand in the market. Now, the fact that that back end curve was going inverted was telling you that term premium were negative. So there was becoming a huge excess demand in the market for very safe long term treasuries. In other words, the 10-year bond is the archetypal safe asset in the US and in the world system. And people had that in great demand. Ignore the fact that the yield on the 10-year was probably rising at the same time. The key point was the spread against the 5-year was actually getting bigger and more negative. And that was telling you that risk appetite was dropping. So you had two features coming at once. The front end of the curve was becoming more expensive for corporates to refinance, and the back end of the curve was flattening, telling you the appetite for refinancing had just disappeared. So, consequently, what do you see in the corporate markets over the last few months? Very little new issuance. And that's just not been a US phenomenon, it's been a global phenomenon. So, essentially, it's been really difficult to get new issues away. Now, the next stage in that process is to say, well, okay, just take a look at that 5 to 10 year spread and look at it vis-a-vis corporate credit spreads. In other words, the premium that US corporations have to pay, particularly at poorer quality credits, to actually get their credits away. What's that spread doing? And the interesting point is it always widens about 9 months after, trailing 9 months after the movements in that 5 to 10 year spread. So if the 5 to 10 year spread is flattening, okay, what it's telling you, invert that, you're getting a much wider corporate credit spread. And what you've seen in the last few weeks and months is that is absolutely nailed on track. Okay. So you're seeing spreads widen as you've seen 9 months earlier, the collapse in that 5 to 10 year spread. It's absolutely going like clockwork. So this looks like a normal credit cycle, but with a bad outcome.
Again, anybody that wants to ask questions, don't hesitate to click on that bottom left button. But I want to expand on this a little bit before bringing some of the audience up here, because you use a term which I was smiling as you were saying it in both in a happy and a sad way, which is you said the 10-year is the archetypal safe asset, usually in the and I'm talking now from an investment portfolio management perspective, based on this research I put out there. And I think I sent you some of that as well in the past. And
Yeah.
in my world, they need that inverse correlation to kick in where treasury prices rally, yields drop as stocks get volatile. Right. So historically, you see that flight to safety, money goes into treasuries, at least for a moment in time. And if you get one of those convex moves right relative to equities, well, that can make up for years of relative weakness against the broader market. The
Yep.
problem is, as we know, they were not the archetypal safe haven this year. They actually, in their drawdown, in a very unusual way, something you've never seen in history, even the 70s, in terms of the sequence of returns, you never had a correlated drawdown where it was the exact opposite. Instead of money flowing to the quote unquote safe haven asset during stock market volatility, the safe haven asset became the risk asset. I want you to talk about a little bit here again before I bring up the audience. How do you explain what happened in terms of that speed on the long end? Because it can't just be as simple as, well, expectations for Fed hikes, because the Fed it handles the short end of the curve. You haven't really had QT. Oh, and by the way, every time the Fed tries to get out of the balance sheet game and they try to reduce the balance sheet, well, yields actually historically have fallen.
Yeah, okay. I think that's absolutely right. Now, what that's I mean, the last point you made is a really important one because that's completely opposite to the narrative of not just the Fed but all central banks and a lot of academics. they basically keep repeating this idea that if you get QE, yields basically go down. Well, in reality, they go up. And if you get QT, they would argue that yields go up when in actual fact they tend to go down. So I'm actually with you there. On the point about the safe asset, I think it's a very interesting point to ponder this, because basically if you could separate out the yield curve, decompose it into rate expectations and term premia, not just theoretically, but actually practically, then you'd have an ideal tool. And what you've seen is that the term premia has behaved absolutely exactly as you would expect. And had you effectively been able to invest in term premia, now you can in a way through spread trades by looking at, say, the 10 5-year spread, then you would have had the ideal safe asset to basically offset equity losses. That would have been great. Now, traditionally, what you've seen in the fixed income markets is that the term premia has dominated all the returns. But what we're basically seeing right now is the speed of the Fed hiking rates at the front end, or potentially hiking rates at the front end, has basically swamped that in the 10-year return, if I'm making sense. So, in other words, what you've got is two moving parts here. If you could choose and take the term premia, that would have still done the job for you. But it's kind of difficult to do that easily unless you look at a spread trade. Okay, let me try and take that latter point first. I think in terms of come back to my original distinction between funding and market liquidity. We haven't done any work on the market liquidity aspects of the crypto market, but we have on the funding liquidity side. And one of the things you can say is that crypto, maybe surprise, surprise, or no surprise, surprise, is very much a liquidity or funding liquidity concept. If you look at the waves or the cycles in funding liquidity, it matches exactly the moves in crypto, one for one, pretty much. So what you could say is the collapse in crypto this year is no great surprise, because funding liquidity has collapsed because of what the Federal Reserve has been doing. And the point I would make, which I didn't kind of get in or make clear earlier on, is that although the Federal Reserve is only just talking about shrinking its balance sheet kind of from this coming month, right? Hey, it's been doing it already since December 15th. And if you look at, I mean, you look at the our Twitter page, which is cross border cap. If you look at that, there's various charts we put in historically that show that correlation. And the key thing is not to listen to what the Fed's rhetoric is about QT and stopping purchases or whatever. It's much more about how they manage their entire balance sheet. And the entire balance sheet, also the effective balance sheet, their liquidity injections, in other words, have been shrinking since December 15th, which happened to be the first FOMC after Chairman Powell was reappointed, and also when they dropped the transitory narrative on inflation. So a lot of things came together at that FOMC. And from that point, Fed's effective liquidity injections have started to go into decline. And that's when the market peaked, or very shortly after that, that's when Bitcoin, etc., collapsed. So funding liquidity, number one, is absolutely key. On the other question you have, which is basically about senior loan and the tips markets, I think the senior loan market, I mean, look, at the end of the day, what you've got, I think, upcoming is a credit crisis, because I think the US economy is going to go into recession by Q3, right? That's what all our indicators are telling us. It's an unfortunate prediction, but I think that's reality from what you've got going on. I would say that the Asian economies are already in recession, and I think the Eurozone economies may be there as well. If you look at the collapses that you're seeing in business confidence right now, it would tend to attest to that. And you're looking at the extent to which you're getting data disappointments from a lot of these economies. It's suggesting that there's a big loss in economic momentum right now. And I think that's what I would figure that the 10-year bond is telling us, because it looks to me that it may be have peaked and yields may be coming down. That's what I sense. So I think on that question about senior loans, I'd still be kind of skeptical. I think in terms of the tips market, okay, you've got a two-way pull here: the inflation outlook and what will happen to real yields implicitly. basically tips are very long duration bonds. Theoretically, if you're starting to get um, duration or an appetite for duration coming back, I think you're going to start to see a lot of performance from tips. I would tend to think that real interest rates in the US could start to come down because I think that there is a recession upcoming. Inflation is clearly sticky. There's no question about that. We do measures or estimate measures of inflation persistence in the US, and we've got readings now which are the highest they've been, or they match. Let's say the last period was 1979, just after Volcker's appointment, and so you've got a lot of persistence, a lot of sticky price inflation in the system. But I still think that inflation's probably peaked here. It may just take several months or quarters really to come down to a manageable level, but I think it's coming back. I'm not in the long term high inflation camp. I think the demographics and other factors are really pushing us back to a sort of core inflation rate of 2%. But hey, it is not going to be instant karma. It's going to take some time. So I think the tips are probably worth having in a portfolio for sure at some stage in terms of getting that bang in the real rate.
By the way, I shared in the space. I put a poll out 2 days ago. Which is a better buy, stocks or bonds? And it looks, by the way, like 60-40 is back because 57% said stocks and the remainder said bonds. And I'm with you on the 10-year yield. And this has been again one of the frustrations, but it's not my opinion. Historically, when lumber is weak as it is now, utilities are strong as it is now, uh, consumer staple defense areas, all that tends to be bond bullish. It suggests that there's a disinflation deflation pulse. And now this is the first time where all the signals that I follow in different ways are all screaming the exact same message. Now, it could be a false signal across the board, but yes, I do. I'm with you on the idea that the 10-year probably is going to have a rally. The thing is, this inflation narrative, I feel, is so ingrained in people's minds that they're forgetting that these are long duration plays, whereas what's happening with inflation may still ultimately be transitory, which is kind of ironic. It's just nobody really defined what transitory was, right?
Right.
Transitory could be 3 months, it could be 3 years. In the context of markets, you can argue that a 3 year period is still actually transitory because markets live in a much longer cycle than we living in the small sample. More of a side note.
Yeah, I think it's entirely possible because funding is critical, and as you say, affordability has really started to drop away. So I think that's a serious consideration. Demographically, I mean, we know these pressures are there are different pressures, but I mean, we have seen. I mean, demographics are not a sudden phenomenon; they've been building over time, and we've seen house price dips before. So I think that the trend and the cycle need to be thought of differently. I think in much the same way as the commodity markets, I think one can build a very compelling case for commodities over the long term. One can build a compelling case for housing over the long term because of demographics. But you've got to remember that on top of that, on top of both, there are cycles. And what I'm saying is that the liquidity or funding cycle is now in a downswing. It's in a dangerous downswing. It's not just the US that's operating here. You've got many other central banks around the world that are following. And I think one of the things, I mean, this is a point to ponder, and it's kind of maybe off theme slightly, but I think that one of the things that I'm very exercised by is thinking that there's a deeper policy message or policy initiative out there. It's not just about the Federal Reserve wanting to get its balance sheet down. The Treasury also wants to get the dollar up. And I think that, in the context of that, we've got to see what's happening globally. And I would fix on, I mean, this may be a spurious link, but look at Janet Yellen's speech, which was made in mid April to the Atlantic Council, that was entitled, or it was about what was called friend sharing. Now, I think the context or the message here is really profound. And I think what's going on is that the US wants to get the dollar up because it wants to create a recession or a squeeze of liquidity in the global economy. And that will tell you who your friends are and who your foes are. Because sure as eggs are eggs, China's not getting any extra dollar liquidity. Okay, but if you're a friend of America, you get the friend sharing and you get the dollars. And this is all about a dollar funding system worldwide. There's been a lot of debate about whether we're in, what is it, Bretton Woods 2, 3, whatever. in my estimation, Bretton Woods never ended. Bretton Woods was about dollar dominance and about the US being at the center of the global monetary system, and I think that still remains. The dollar now is preeminent, and dollar funding is critical. And I think you've got to think of this other dimension. So if the Fed is trying to create, or the Treasury is trying to create, a much stronger dollar, what is the impact going to be on the international economy and more particularly on commodity markets in the short term? So I think these are points out there that need to be raised and debated. Yeah, I mean, hold that thought because I think it's a really, really key point. But I think what you've got to also then extrapolate is what's happening to the food crisis. And the food crisis, Ukraine particularly affects Middle East and Africa because a lot of grain exports come out of Odessa into those areas. Now, if that grain is halted and you start to get an explosion, which clearly you're getting already in food prices, what's going to happen is there's going to be problems with feeding populations, and then you're going to get migration. So it's not just the point about Russians and Ukrainians migrating, it's actually North Africa as well, and maybe the Middle East. And where are they going to move to? Hey, Europe. So Europe's got a whopping great migration crisis to face. You ain't seen nothing yet, I think. So I think Europe is in the eye of the storm here. And the problem is that the politicians just don't have the ability to address these questions. They're not even on the same page. And broadly, where you've got the problem in Europe is much more in the southern fringe, clearly by geographical reasons. And are the Germans or the North Europeans likely to want to bail out the South? They've never shown that willingness before, and I think they're gonna balk at the idea again. So I think there's a real threat here that the eurozone is going to come under great tensions, pretty much like it did in 2010-12.
So okay, so now let's go to this commodity discussion for a bit because I always say there's no gurus, there are only cycles, and it's been a real argument, which I think we all agree on, that there's a long-term cycle that favors commodities, but within longer-term cycles, there can be some pretty nasty drops. Talk about the interaction of liquidity to commodities historically, and how you think commodities could play out in the near term. And I say that because I see a hell of a lot of people that may ultimately be right about the direction, but wrong about the way it gets there, or gets to its endpoint, so to speak.
Okay, I think we've got to. I mean, again, if you're looking at commodities, I think you've got to try and split out different areas, and I think it may be different. The supply and demand backdrop may be different for oil or gas or grain relative to, say, copper or lithium or whatever one's talking about. So I think there are clearly specifics. There's color there, which in a broad brush we're not going to get. But I think in terms of the general dynamics, I think there are already two things to say in this. One is that there's a negative feedback between liquidity and particularly energy prices, oil prices. In other words, if you see big spikes in energy prices, as we've seen now, as we saw in 2007-8, that has a very negative effect on liquidity for a number of reasons. One is that you need more cash simply to transact in the real economy, so that gets dragged out of financial markets. Another reason is more volatility in the energy markets means that anyone that's got energy-related credits or loans will have to face higher margin requirements, and that may detract from credit. Or again, central banks may have to tighten more because energy inflation is a key component. So
and sorry, not to interrupt, and but that basically what you argue is there's kind of planning volatility, right? Because the speed is so aggressive, you can't necessarily react from a longer term perspective to it, so it just creates a whole bunch of havoc.
Yeah, exactly. I think you've got that. That's one of the things that we're clearly getting now. I think the other side of that is, is there then a positive feedback from more liquidity into commodities? And the answer is very clearly yes, but that tends to come down the conduit of China. And if you look at the People's Bank of China, and I think we've put on our Twitter feed, Cross Border Cap, there have been charts historically which show this correlation. There's a very, very close correlation between PBOC, People's Bank liquidity injections, and commodity markets. And in other words, if you get the PBOC easing, commodity markets go up. If the PBOC tightens, commodity markets go down. because China's got such a huge industrial footprint in the world, and they're big commodity users. They're big importers. Now, we got to say here that China is not in a great place. And what you're likely to see this year is the weakest growth that China's had. It may even be a year when the growth rate of China sinks below America's growth rate for the first time since the mid 1970s. So, sort of hold that thought. That's clearly a big statement. And the U.S. economy itself may not be that great this year, but China's going to be worse. Now, the problem that China's got is not just the COVID-19 lockdowns, which have been a complete disaster. And if you look at latest economic data coming out of China, I mean, it's just plunging. The numbers are not great. I mean, this policy has not worked. There's a big economic cost. But the question is, can China stimulate the economy again to try and revive growth? And I don't think they can. And I think the reason for that is that they've got themselves in a real policy bind that America is very ably exploiting. And that is because China switched about 4 or 5 years ago from a policy of growth at all costs to a policy of stability. And the idea behind the stability policy was ultimately this was paving the way for the Chinese yuan to challenge the dollar in the long term. And what China needed was some sort of bedrock of stability in its economy whereby it could promote the yuan. And therefore, what they've been doing is that at all costs, they've been trying to keep the yuan stable over the last 5 years. Consequently, the big liquidity explosion in China that you'd seen in the wake of the GFC petered out, and they've really done nothing for the last 4 or 5 years. In fact, ever since something that people refer to as the Shanghai Accord in 2016. Now, the Shanghai Accord was an attempt to try and then stop the dollar going up. And I think my interpretation of that was a secret deal, so I don't know. But my interpretation was that the Asian economies collectively tried to form what you might call an Asian euro. So the Chinese yuan was at the center of that, and everybody gravitated around the yuan in terms of a stable exchange rate. Now, if you look at the data, what you will see is that Asian currencies through the last few years have seen the lowest volatility that they saw and since the Bretton Woods deal broke up in 1971. Okay, since the end of that deal, basically currency volatility has never been lower than it was up to March of this year. Then, bang, in March, you start to see the tree being shaken. And initially, it was the yen that collapsed. Now, why did the yen collapse? Well, people say to me when I debate this, well, hey, look, this has been an accident waiting to happen for years. You know, the Japanese have been doing this real reckless QE policy. It was only a matter of time. Yeah, but why in that particular week, immediately after the Ukraine invasion, do you suddenly get the Japanese talking their currency down, almost a straight line devaluation of the yen? My point is this a Trojan horse or a stalking horse that's trying to achieve something else? Coincident with that, you get Yellen's speech about friendshoring. In other words, treat your friends well and you will get dollars, etc. And within a month, the yuan comes under big pressure. Okay. Now, the point is that the Chinese cannot hold the yuan where it is when the economy is so weak and when the dollar is going up. They have to tighten even more. And if you look at monetary operations of the People's Bank of China, which we do every day, what you can see is that this is normally or should be a seasonally strong period for the People's Bank. What have they done in the last 8 weeks? They've taken 800 billion yuan out of their money markets. That's $120 billion, when they should normally be putting lots more back in. So there's a real problem out there for China. And I think that the whole idea of getting the dollar up is a ploy, a policy to shake the tree and basically try to put pressure, put the Chinese feet to the fire here. Their economy is not great, and this is going to be a big problem. If China is forced to tighten more, you're going to get a commodity price collapse. And I think, looking even at the price of copper is telling you, and maybe your indicator lumber, Michael, is telling you there are problems out there.
Well, it's funny we're talking about this because I had a direct message question from somebody saying, can China's reopening put a floor commodity prices. But from what I'm hearing from you, it's not necessarily about a reopening. It's about this kind of currency aspect, which could cause a real breakdown in the asset class near intermediate term.
Yeah, I think absolutely. I think that I think it's very difficult for them to do this anyway. I think their economy is compromised, but has been compromised by this. And if you look, even people, you've had. I mean, you get, as you know, in Wall Street and whatever, you get analysts who are always saying, oh, they're going to ease tomorrow. They're going to ease tomorrow. This has been going on for the People's Bank for basically 3 or 4 years now. Everybody keeps saying, these analysts keep saying, well, the People's Bank's bound to be injecting more money, and they never have. And even if you look at the package that was announced last week, by Li Keqiang, the premier of China, this is 1/20th of what they put in after the GFC. Okay, it's de minimis. I mean, it's 1/20th in yuan amounts, but we've had 10 years or 12 years of history since then of where nominal values have gone up anyway. So it's probably even less than 1/20th. So this is nothing. If they're going to ramp the economy up and get it revived, they're going to have to really turn around and inject lots of cash into the markets. And if that's the case, I don't think the yuan, I mean, it's not going to stop at 7 yuan to the dollar. It's going to go up through that. There'll be a serious devaluation of the Chinese yuan. Now, that, in a sense, may be what the US Treasury is trying to do. I don't know. Maybe that's the tactic. I mean, one scratches one's head here. But I think it could be, because if you start to get a serious devaluation of the yuan, can China seriously be part of the international trading system with a much, much lower yuan? I don't think it can. I think it's then kicked out of these supply chains because it would basically just be too disruptive. You'd have to put a lot more tariffs on China just to knock it out. And that may be the idea. What we're going back to, and I've repeated this, or I repeat what I said earlier on, the Bretton Woods deal that was enacted, that I think still exists, was actually a deal for the free world after World War II. It was basically excluding what was then called the Second World, the communist world, and it was basically a way of the dollar circulating within the free world economy. And I think that's what we're going back to again. Now, I may be completely wrong, but that's what I sense is the direction. No, I think you're right on. You're approaching it absolutely correctly. And I sort of said as a sort of caveat right at the beginning that I think you've got to look at commodity markets very, very specifically. Generally, I think commodities will kind of come under pressure because they're clearly they're very closely connected with the business cycle. And to the extent to which this funding crisis or this liquidity collapse is going to cause a business downturn, then I think you're going to get reduced demand for a lot of commodities. However, there are some things that have changed phenomenally, and one of them is by taking 6 million barrels a day of Russian production out of circulation, or in theory, that causes a big hole in supply in the world economy. And I think what you were seeing even before the Ukraine invasion and this Russian dislocation was the fact that the world was getting short of oil because the appetite of the Chinese economy for energy or oil-related products is so great that, broadly speaking, we need a lot more supply. And the fact is that we can't rely on Russia for that. Now, even if you sort of hypothesize that China is going to take in the long term more Russian oil, that's clearly something that's infeasible in the short term because the pipelines don't go in that direction. So I think what you've got is a lot of supply disruption, which may well keep the energy market elevated for a lot longer. But I think that's a specific case. Whereas if you look more generally at commodities, those that are associated with the business cycle and don't have the same supply disruption, then I think it's a different story. I think in the longer term, as I said at the beginning, the trend is there for commodities. The trend is there for housing. The trend is there for oil, probably even more than an average commodity. But on top of that, you've got a cycle. And what I'm trying to say is that let's not get ahead of ourselves with the commodity complex. Pick out and cherry pick. Sure, you'll make better money that way if you understand the supply dynamics. But what I'm trying to argue is that liquidity is a key factor for every investment or every asset class to take into account. And it's going down. It's going down more.
So that brings with it the tweet I shared in the space that I put out in October of last year, and I've said this a couple of times since then, that we're closer to a global margin call than most think. And candidly, I back then was hoping that would be the case, but in the sense that if that global margin call takes place, treasuries would rally and have the risk off period, and hopefully those signals get it right well in that kind of high volatility correlated downside. Of course, it ended up being treasuries that correlated on the downside, even though historically that's not usually the case. I am curious your thoughts, Michael, here maybe for the last several minutes. How close are we to sort of that kind of global margin call with liquidity collapsing the way that it has? I've seen you talk about how you think stocks could go down quite a bit more than people realize, but I want you to riff a little bit because it kind of dovetails a little bit to John's point that if we're talking about a commodity collapse, maybe it's just a risk collapse.
Yeah, I think that's a fair, maybe a better way of putting it. I think that what I would say is that if you look at markets generally or risk markets, what you tend to have is a second leg down, and that second leg down tends to be associated much more with a skidding world economy or a skidding economy, and I think you get that from maybe Q3 or early Q3. I think that's the likely time horizon. My take on this has really been that if you get a straightforward liquidity squeeze, you normally get a correction in equity markets of about 15%. If you throw in a recession, you're talking about 30%. And if you think about a banking collapse as well, it may be 50%. Now, I don't think we're going to get the banking collapse this time. I think we do get credit problems. I would put us much more in the 30% camp of peak to trough declines. The S&P went down, a touch on 20% down. It's rallied. You'd expect a bear market rally. Bear market rallies can be vicious. They can be enticing, often exciting, but they are just rallies in a long-term downtrend. The question to ask is the Fed done with tightening? I don't think it is. I think there's a lot more to go. If you look at some of the hawks in the Fed, they're talking a lot more aggressively now. They're talking about major shrinkage of balance sheet. If you think that the Federal Reserve is going to take $2 trillion out of the balance sheet as they once slated, you're looking at the S&P at about 3,100, 200, that sort of level. So it could come down a lot more from here if that's the case. But I think the Fed will bulk before it gets there, and I would tend to suggest that when you get credit markets being hit badly. It hasn't happened yet, but clearly spreads are widening. Once you get that sell-off in credit, then the Federal Reserve is going to start to blink and come back again. And as we know, the Fed always tightens until something breaks, and that break point normally comes in the credit markets.
But that's an interesting way to also end the conversation in the sense that credit spreads need to widen for the Fed to really pay attention and maybe slow down or reverse. Credit spreads have been abnormally tight, you can argue, relative to volatility because commodity prices, oil in particular, has been elevated. A lot of these junk issuances tend to be heavy commodity drillers. So you almost need to have commodities break down for spreads to widen for the Fed to pause.
Yep, I think that's a fair point. But I'd say that just do a very simple test to see what I'm saying. Look at the 10 2-year spread inverted against credit spreads. There tends to be a very close connection with a 9-month lead.
All right, so again, everybody that's here, please make sure you follow Michael Howell. Check out his research. Try not to take liquidity.com from him because I'm trying to take it from him because it's such a phenomenal domain. Michael, you're the man. I appreciate you spending this Sunday here with us. And again, thank you, Michael, for all of your knowledge here.
Great. Thank you, guys. Have a great Memorial Day. See you.
All righty. Cheers. Thank you, everybody.
Thanks, Alan.